Hi everybody, this is Seth Martin with Middle Class Investor. Today is August 9th, 2014, and we had a pretty big sell-off this past week in the market. You can see here just on the screen, just on Friday we had a 185-point down day in the Dow, which is, that's a pretty good down day. The reason I have the Dow up on the chart here, and I just want to call brief attention to it. This upper trend line that you see here, this red trend line, I've had this on the chart here for a long time, but it's really marking the 2000 high. So this was the run up into the dot-com bust. And you can see here the market topped around about 11,700, and then we had the dot-com bust, which came to a low of around 7,100 on the Dow, and then we had the run up into the housing bust. So this was rates were being lowered, and we had the run up into the housing bust, and that peaked out around 14,140. And you can see here that it basically hit the trend line. Looks like it hit it twice. Kind of popped up, sold off, popped back up, and then sold off for good. And then this time, the market ran up, hit the trend line, sold off, and then actually made it through the trend line. Let me zoom in a little bit. Let's look at that. Tell you what, let's look at it on a weekly chart, since we were looking at a weekly chart to begin with. So you can see here the market ran up, hit the trend line. Now this trend line, is intact. I mean, if you connect the 2000 and 2007 high, it just so happens to intersect right here. So the market came up, hit this, sold off, ran up, touched it, sold off, exceeded it for 1, 2, 3, 4, 5, 6, 7, 8 weeks, sold off in the 9th week. And you can see here I've got a small degree bearish wedge here, and we've broken out of that bearish wedge and have sold off. Support held. It looks like it's going to hold. We won't really know until the market moves up above this bar here, which is last week's bar, and moves up to it. Now, it's likely that we'll come back up, test this line, this line that goes all the way back to 2000, and then maybe sell off. So what we're going to be looking for, and I'll talk more about it here in a minute, but let me look at the S&P 500 first, because let's look at it on a weekly chart. And there's something that's interesting here. Same trend, same type of trend line. But the interesting thing here is the S&P, it moved up above it pretty strong here, but it really never, I mean, this is a close above the line, this is a close above the line, but really, other than those, this really is the only close above this trend line. The rest of it, I mean, you can tell that the trend line was really giving the market trouble, which is interesting. There's nothing magical about these trend lines, except other people also see them. But really, this bearish wedge, the significance of it is that, I mean, we call it a bearish wedge, but really what's happening is, and I've talked about this before, is price range is narrowing between the high and low of these trend lines, and it just makes it more and more difficult for traders to make money. So that's what causes the market to eventually sell off, and that's what we're looking to happen. Now you can see here that support held, which we talked about last week. We thought it would hold. I thought this would probably be the low. Let me pull up a daily chart. I thought actually this day right here would be the low. The market ran up, but then sold back off. So What we're looking to happen now, let me zoom in. What we kind of want to watch for is any kind of action that doesn't result in a higher high. So you can see here we came down to this low here. This low right in here. And then we had a really strong move up on Friday, which is typical. Once the trend kind of bottoms out, which here we had a trend down, okay. Once it kind of bottoms out, you get the first move is pretty strong, okay. And so typically what you'll get is kind of what we've got here, and it will probably get a continuation next week, maybe into this area here, or it might sell off first. You know, it's hard to say. Really, it could actually just sell off first a little bit, and then come up into this area, and then maybe sell off a little bit more, something like this, okay, and then come up into this area. Now I've already put this. Now it actually could go a little bit higher, even something like that. Maybe to this midpoint line. I'm looking for something in this 1950 to 1970 area. And then, just like in the bond market we talked about, if this is in fact the first move down off the high, and this is the first correction into the first move down, that means this next move down is going to be substantial. Now, let's talk about some different, how you might handle this. And it's different for different people. Some people are going to go, I'm just going to wait and see, if we break, let's say 1890, that's when I'll go to the sidelines, okay? And that's fine. There's nothing wrong with that. In fact, if you have a 401k, that's probably a really good strategy. The only downside to that is, it could be a pretty big move. Most of your 401ks, your net asset value is calculated at the end of the day. So if you happen to have a day like this one right here, but let's say it's even bigger because now it's in this next wave down, you could have given quite a bit back. But that's part of the rules, right? Whatever rules you have. The other thing you could do is you could say, well, anything that looks like a lower high, in other words, this high is lower than this high, then that's it. I'm going to say the trend is changing. And maybe you wouldn't normally say that, like if you were back in earlier part of the trend, but because we're in this rising wedge, if we don't come up and make a higher high, then maybe you can say that. Now, what do you use? Do you use daily charts? Do you use weekly charts? That's different for everybody. But let me suggest that if you have a 401k, maybe you use a weekly chart. So let's look at a weekly, for example. Let me just change this to a weekly. And then let me zoom in again. I mean, it's almost not enough move. There's almost not enough space here to kind of do this like you would think about it. But let's say it came up and made a high like that. Maybe even went a little higher. Maybe closer to this 1970 area. But then, came down pretty sharply. Well, if you got a close, think of it like this. Think of this as being the high day, but envision it being right here. This candle being right here. Any close, if you get a close below the low of this high day, okay, so this would be your high day right here, but that would be the low of the high day. So pretend that this candle is right here, okay, and the next week, the very next week, you got to close below this low. It'd be kind of like well, it'd be like this one, but maybe, you know, ideally it would be something a little shorter. Let me see if I can draw something. Let's suppose this goes up. I'm just going to draw boxes. I'm not going to draw the candle and the wick and everything. I'll do it on the one. Let's say it goes up like this. And then let's say there's a little wick on this one. Something that looks like that, okay? And then maybe you get something that looks like this where it goes, you get a big bar like that, and then you get something that looks like that, okay? That would be a close. The close would be right here below the high day. This would be, of course, this is the high day now, right? So that's really not, let me do that differently, because that's not going to make sense. Let's say the bar looked like this, okay? Maybe it was only slightly higher here. I'm just trying to give you a sense of, so this would be the high day, and this would be the close below the low of the high day. This could be the place where you make a decision, okay? Right here at 1931-ish, okay? But you have to, if you're gonna do this, if you're gonna protect yourself against what might be, see, we don't know the future, we only know that what might be, then you have to have some sort of strategy like this. And I think a weekly chart is a good chart to use if you're dealing with a 401k, if you're trying to protect your assets in a 401k. And the reason I say that is because if you go back, let's go back a couple of years, what you're going to find, let's go back into here. So here's an example right here of a close below the low of the high day. So here's the close, here's the high day. So this would be a close, this week right here would be a close below this low of the high day, okay? Now you can see that would have paid off because the market, let's see, went from 1450, closed down here at 1428, so 30 points or 20 points. Maybe that's, you know, that's not where you want to be getting in and out, right? So this could do the same thing. It could save you 30 points, and then you're looking at, you know, getting back in. For example, if we're doing this day by day, right? See, maybe somewhere in here you wanted to get back in. See, you have to have a strategy for getting back in too. But because this rising wedge is so long in the tooth, I think it's a fairly high reward to risk. Okay, think of it like that. Think in terms of probability, given this pattern, that if we come up and we make a lower high and start to come down, this is likely to be the next move down, and they're likely to be significant. I'm trying to think if there's a market I could show you that that looks like this. Maybe in the NASDAQ. Well, I'll tell you what. Let's go to the S&P 500, and let's go back to the financial crisis, because I think that's very relevant. And let's look at a weekly. Okay, so here's the high week right in here. Right here. Let's say this is the first move down right here, okay? So here's your first move down. Here's the retrace up. So here you can see there's a bar up, and then we had a bar down, but we didn't get a close below the low of the high day. We had another bar and another up and then another down, and then here's where we closed below the low of the high day. But look at how much longer this move is than this move. In fact, let me just measure it real quick. If you measure this from here to here, that was 170 points. So that's your first move down. And then if you measure from here to here, that's 253 points down. Now, the interesting thing about the financial crisis, if you look at this in terms of the first move down, let's just look at the whole crisis. If you look at this, where was I? This right here, from October 8th to March 17th. So if you look at this as the first move down, from here to here, that was 289 points. Okay. The second move down, or excuse me, the second move down, which would, this move right here, that was 700 points. Now this is on the S&P 500. So 700 points on the S&P 500 is a very significant move. So let me show you. We're going to show you a tool here that you can use. If you go to the low, okay, and you go, there's a tool. There's a series of numbers called Fibonacci ratios. And Fibonacci was an Italian mathematician who discovered some interesting ratios. You can do some homework on it if you like on your own time, but it's just an interesting series of numbers that show up in nature and various growth patterns and things of that nature. But a lot of times you can take the first move down back to the top of the first move, and you'll get this 261% kind of number will show up, and you can see that it was pretty close to that number during the financial crisis. So let's just, understanding that, let's go and let's say this is the first move down, and take our Fibonacci tool and go from the low here back up to the high. And let's see where our 261 is. Our 261 is down here at 1764. So, you know, we could be looking at, if this is the first move down, and then we're fixing to have the correction back up, you could be looking at a move down to the mid 1700s, 1750-ish. Now that's a significant move, and that will take your money. That will cost you big bucks. In fact, let's measure that real quick. So if I measure from here down to right here, that's almost 11.5%. So, you know, that's pretty significant. We don't want to lose that money in our 401k. We worked hard to put that money in there. In fact, depending on how long you've been putting money in there, that could be very significant. So we really want to understand what's happening in the context of this rising wedge pattern. Okay, so we beat the rising wedge pattern story to death, but we've got a move down, a pretty substantial move. The only move that you see here on the chart that was more substantial is this one right here. And this was kind of in the middle, not in the middle of the pattern, but it was still fairly early in the pattern. The pattern is very mature right now. And the thing that's got me thinking that this could very well be the first move down is the difficulty that the market had around this upper trend line. To me, this is a clear sign of exhaustion. You know, the market is really exhausted here, and traders are having a hard time, you know, coping with the fact that there's not as much room here to make money. So I think that's enough of that. I don't want to belabor that, but we are looking, or I'm looking, and I'll be talking about, looking for the market to move up into this 1950 area, and then we'll look for it to recoil back down. But I would say, if you wanted to be conservative, close below 1895. You really should be looking for the sidelines in this market, unless you're willing to let it go all the way down to 1750, for confirmation. And that's a big move for confirmation. So let's look at the bond market. The interesting thing about the bond market, I think, is the interest rates went actually a little lower. Now our support line still held. We didn't get a close outside of this box. So since we didn't get in fact, let me use a weekly. Let me use a weekly chart, because what I was looking for is if we get a close down below this area, below this 2298 area. In other words, if we get a candle, I hope I'm not confusing you guys with the terminology. I'm just talking about where the market closes. But let's say next week, for example, let's say we got a close, let's say we got a bar that looked like this, and then maybe we got another bar that looked like this, okay? And it actually closed below, maybe even it had a long tail on it, but you had a close down here below our support box. If you see something like that, I think I think we're going to see interest rates fall all the way down here to this mid 1.5 area. And if there's enough panic in the market, that certainly could happen. It's just hard to say. It's hard to say how people feel about the bond market. There's a lot of talk about the bond market being way high, overvalued. We're at the end of a very long interest rate cycle, and so a lot of people are afraid of the bond market. But there's also this law that says these institutional investors have to be 95% invested in something. So when the market sells off, when equities sell off, and there's been a big rush into equities because of low yield. But low yield is better than losing money. Okay, if a market, if an institutional investor is faced with losing 20% of his money, or going into the bond market and only getting 2% or 1.5%, he'll take that 1.5% any day over losing 20%. So what happens is when you start getting a sharp sell-off here, a lot of money flows into the bond market, which then drives yields lower. So I can definitely see a scenario where that would happen. Whether or not it's going to happen, it all depends on how traders feel about the risk in the bond market. A lot of them feel like there's a lot of risk, but the bond market is also the largest, deepest, most liquid market in the world. So when you got to move a lot of money fast, that's where they move it. The euro-US dollar looks like, to me, we're looking at a weekly here. We can go out a little further, maybe a 5-year. But to me, the euro-US dollar looks like it's not gonna get up here into these highs. It looks like it's made its high and is rolling over, which means, it could be in some sort of consolidation. Oh, excuse me, where the highs are getting lower and the lows are getting higher. In which case, it can consolidate down into maybe this area, but it's real hard to say what that's doing. I would say that if the dollar, we can go look at the dollar. If the dollar, well, let's look at gold first. When it comes up, gold is definitely in a consolidation pattern. Gold was up here at the highs of 1900. It sold off. It bounced back, sold off really hard, and that's been consolidating ever since. So we expect gold to maybe it might bounce it back up into this trend line, but eventually it's going to make a lower low, maybe around $1,000 or so. But let's look at the dollar real quick. The dollar index, DX/DX. See, the dollar looks like, I mean, this area right in here, this 78.70 area, it looks like it's held for a long time now, since 2012, and now the dollar looks like it's wanting to run up. So if the dollar runs up, then you're going to see the euro come down. So those tend to go in opposite directions. One thing I want to show you today, since we're talking about gold here briefly, is a ratio chart, because I don't want to get political in this YouTube video, but I think it's important for people to understand about our monetary system and the nature of it. We have what's called a fiat currency system. In fact, every country in the world uses a fiat currency, which means it's just, there's nothing backing it. It's just, the only thing that really makes it valuable is our willingness as citizens to use it and to put value on it. That's it. So I've got something here called a ratio chart. This is this is gold. Let me move this out of the way. Pull up a 10-year. So you can see here, this is gold. I mean, this S&P 500 divided by gold. So think of this in terms of what's the value of the S&P 500 in terms of real money or inflation adjusted. And you can see that since about 2005, the S&P 500 has been in a downtrend, and it looks like the downtrend bottomed out in real terms, okay, in terms of gold, which has real value, intrinsic value, bottomed out in 2011, and then we've been in this counter trend rally coming up. And it's starting to look a little, I mean, you can see how strong it was through this area, and then it's starting to look a little tired here, and if this starts to roll over, which it probably will once gold starts to roll over again in the market. See, what will happen is gold will roll over, but the market will roll over even harder, and this will come back down. But another, again, I don't want to get into a political discussion with people, because different people have different politics. But something I want to call your attention to, there's a great movie on Netflix, and I've got it here. It's called End of the Road. So you can see it here. It's called End of the Road: How Money Became Worthless. Now you can watch it online on just Internet Explorer for free, or you can purchase it. Or if you have Netflix, you can go to it under documentaries. It's a really good. They use a lot of good graphical types of illustrations to show you how money is created, what the Fed does, how the banking system works, how inflation has eroded the value of our dollar, which basically over time takes money from you. And I don't know, some of you may find it boring, but I think it's important to understand the Fed, the money system, and how it impacts you, because it's part of how you can benefit. I mean, one of the reasons these guys like Warren Buffett are so rich is because they understand all this, and when they understand it, they know how to take advantage of it. The problem is they're taking advantage of it at our expense, and it's no big deal because they're just one person, but Warren Buffett's $50 billion worth of wealth, basically everybody in the country has contributed to it, in the form of inflation, his ability to exploit inflation and things like that. The other thing I wanted to mention is margin debt. Last month, in June, was at a record 464. I think this is. It says it's in millions, so $1 billion. $464 billion. That means people are borrowing money to buy stocks. And let me go back to the chart just to illustrate how these manias happen. See this line here? Well, let's look at the Dow. The Dow's even better. Look at the Dow. See this line here? People are borrowing money, okay, as crazy as it sounds, to buy stock at this point right here, at the absolute peak. Now, that's pretty crazy. Now, what you're looking at here is a monthly chart. So, you know, on a monthly basis, you can really see how strong this line of resistance is. I mean, this up thrust, where I have my little yellow circle, it came out and it closed above, but then the following month it ran up and then closed below. That's usually fairly bearish, but we'll wait and see. And like I said, we're going to look for some confirmation. Depending on how much confirmation you personally need will dictate what you do when this starts to show you a rolling over signal. But like I said, a move out of this wedge on the S&P 500 is going to take you down to this probably just below this low right here. So it's going to be pretty substantial. So that's it for this week, guys and gals. I want to thank some of you out there for commenting on the YouTube video. A number of you have commented, and I really appreciate that. If you want to have more of a dialogue, questions, question and answer, just say that in the comment, and we can certainly do that. If there's something that anybody in the group wants to talk about or wants me to talk about specifically in a video, something they don't understand or something they need clarification on or what have you, I'm happy to do that as well. This is an interesting subject to me. I know it's not as interesting to most people. I want to make it interesting enough for you so that you stay engaged, so you don't lose money. But if I start to get too deep in the weeds, let me know, and we'll pull out of those weeds, and we'll talk more about just general market action and what's happening. So that's it for this week. Thanks for everybody coming in. To the Middle Class Investor, you can forward the link to friends and family. You can follow me on Twitter at InvestorClass. And until next week, we'll see you guys next time. If the market starts to do, if we start to get a correction and something looks like it's starting to happen, I may do a video midweek or something, but other than that, probably won't. So it'll probably be next Saturday or Sunday again. Okay? You guys take care. Thanks a lot. Have a good week.